Sometimes the only thing more expensive than being insured is not being insured. Depending on how you itemise the cost centres, insurance is, for most ship owners, the second largest outlay after crewing costs, typically accounting for about 10 to 15% of opex. Now, it's hard to itemise the bill in dollar terms as there's so many variables involved, not least loss records. But according to the Baltic Investor Indices, the all-in cost of insuring a capsize is currently pushing about $250,000 a year, and the hit for an MR tanker is well over twice that. Some covers are optional, some are not. Protection and indemnity insurance, effectively the third-party fire and theft of the shipping world, is mandatory. A so-called blue card, issued by a P&I provider as proof that cover for oil pollution liabilities is in place, is nothing short of a ticket to trade. Which of course brings us to the topic of this week's podcasts. The P&I niche is currently about halfway through the annual ritual known as the renewal round, the months leading to the traditional hard deadline of February the 20th. By that point, 90% of the world fleet by tonnage will have renewed P&I policies with one of the 12 clubs affiliated with the international group. The period from late October to mid-December sees the marine mutuals that make up the IG set out their pricing policies for the year ahead. At the time of recording, we were just over the halfway mark, with 7 clubs having set out their stalls. All of them are demanding some money. The silver lining here is that the rate of increase is slowing down. To date, 3 clubs have said that they are seeking price hikes of around 5%, and a further 4 are looking for about 7.5%. That's only to be expected, being roughly in line with inflation in most OECD countries. Or to put it another way, it's a lot less than the price increase you'll have seen in your weekly grocery shop. Coming after the 10% seen in 2021, the 12.5% in 2022, and the 10% in 2023, compounding out at about 46%, it's an indicator that the clubs are on a surer financial footing than they have been for some time. Another marked feature of this renewal round is an increase in cashbacks. P&I clubs are mutuals, don't forget, making them an example of what economists call profit sufficers rather than profit maximisers. If they do achieve an underwriting surplus and their free reserves pass a health check, well, they can decide to return some of that extra money. Indeed, on one argument, they are duty-bound to do so. 3 clubs have opted for some sort of capital return this year, with Gard, the world's biggest P&I player, leading the way. Owners signed up with the Norwegians can look forward to a rebate of around 10% of last year's premiums, more than double the 5% target revenue increase. Our insurance editor, Dave Osler, has done a back-of-the-envelope calculation, as he does, and he's worked out that the sums involved run to over $80 million. But is this really an act of random kindness? What's the catch? Why not just cut prices and have done with it? These are all questions we put to our guests this week. They are being Jonathan Andrews, Chief Executive of Steamship Mutual, who was in dialogue with Alex Vullo, Director of the leading broker Gallagher, Tom Bowsher, Chief Executive of West of England, and Thya Kathiravel, Chief Underwriting Officer at Britain's biggest P&I club, the recently merged NorthStandard. Our first clip sees Dave talking to Jonathan and Alex. For context, Jonathan has signed off on a board decision to offer Steamship members a 7.5% cashback, more than wiping out a 5% rate hike.
One of the themes of this year's renewal round has been the distributions to club memberships, with 3 clubs at the time of recording returning money under various guises. Now, Steamship Mutual strategy has been to seek a 5% general increase offset by a 7.5% cashback for owners who had entered mutual tonnage at the 2023 renewal deadline. So the distribution more than offsets the premium increase. What's the logic of doing it like that, Jonathan? Why not just cut prices?
Well, we see them as 2 very distinct issues, David. The capital distribution comes from the strength of the club's balance sheet, and that is achieved through stability in our operating performance, but also in the accumulation of capital that we achieve through the investment of the reserves that we hold on behalf of the members. So if you are achieving an investment return, as we are at the moment, given the prevailing interest rates in the region of 5 and 6%, say, that quite quickly rebuilds your capital position from the losses of prior years, certainly the 2022 financial year, and you see projected capital increasing quite significantly, always on the understanding that your underwriting performance is break even or better. So the board look at those things and decide whether we have sufficient to be able to release some of that excess capital back to the members. And it's in the nature of our relationship. We're mutuals. We should be doing these things. We don't need to accumulate significant excess capital. It's always nice to have some, but we don't need excessive capital in the business.
Well, what do you say to that then, Alex? I mean, from the broker's point of view, and I suppose more importantly from the ship owner's point of view.
I think Jonathan summed it up quite nicely. The cashback and premiums are two very different things. The issue with the market for the last 3 years has been rating inadequacy in combination with claims. Some clubs have done better than others in terms of claims and performance, Steamship being one of them. So, as Jonathan says, when there's the ability to give back some capital back to the membership, in contrast, still trying to get the rates up to more adequate levels, it's helpful. Do the ship owners, obviously they're going to see it as a positive because it's still going to help their budget, but they will also see their rates continue to increase, which ordinarily you would see in 2024 anyway because of the fundamentals of a fair market. So nothing much more to add to what Jonathan said.
Okay, well, look, let me put to both of you a quote from Ian Harris of Tysers, who said, quote, "A very purist view would be that members of the club who contributed to any specific policy year's surplus should be entitled to receive their proportion of that surplus, irrespective of whether they renew with the same club for the subsequent policy year." Is that a fair point?
I think from a club management point of view, I mean, we're very fortunate, David, that our members are long-term partners with the club. We don't have a constituency that is moving club to club, policy year to policy year. That isn't the nature of our business. And one of the reasons why that's important is that we have a very long tail liability to insure for them. So any one policy year it's not the way that we tend to view our financial performance. We look at a financial year outcome, which is the net effect of all of our outstanding liabilities. So we tend to look at these things more in the round, reflecting the fact that our members are long-term partners with us, that we don't look at one particular policy, be it bad or good in performance terms. If you took that argument to its conclusion, one very, very poor outcome in a particular policy year would create a hiatus on the other side of the equation. You'd be asking for significantly more premium from a particular group of members in that policy year. That wouldn't be right, I don't think. Neither would it be right to reflect on a very good policy year, for example, the outcome last year because of the beneficial effects of the pool. We take it in the round, we look at the financial performance on a financial year basis, and that is a better reflection, we believe, of our operations.
Right, Alex?
There's some conflicting views on this particular subject, to the extent that you've got some members that have been in a club for, let's say, 30 years, and they've helped contribute to the club's financial position, and they're getting capital distribution off the back of that long-term relationship. And then you've got members that have maybe in the club for a year or 2 years and start to get the same reward, let's say, But that's just good timing for them. So some members could feel aggrieved about that. From our perspective, we work for the ship owner. We want to make sure they've got the right premium levels or the most competitive rates available that also technically sound and keep a balance there. But cashback, I think we will see come more into the fold as the market starts to stabilise in the forthcoming years. And you're always going to have different views from different people. The clubs that are able to give cash back will be seen more positively than those that cannot.
It is noteworthy that the 3 clubs to have announced cashback so far are all rated at least A stable by Standard & Poor's, and therefore are not concerned about their ratings agency status when deciding to return any surplus. I mean, clubs with less favourable ratings will be keen to improve their standing, and on S&P's methodology, that normally means boosting free reserves. Is that a fair surmise of one of the factors at work?
I think S&P have an in-depth understanding of the P&I market built up over many years now. So I think they are interesting observers, commentators on the market. We work very closely with them in order to ensure that they understand our strategy and where we are as a company. So yes, I think it's something that we observe. The decision making around our strategy is not determined by S&P. It's determined by the board, of course, and that's what's driving us at the moment in terms of our capital management view. I think it's also true that S&P will look very carefully at underwriting performance as well. So they'll look, and I don't know where the emphasis might lie for them, but they'll look at the capital adequacy, the capital solvency position of the company as their rating, but they'll also look critically at how the underwriting performance is as well, and we're seeing that, I think, in the market at the moment.
Alex?
The A-rated clubs, David, are extremely well capitalised. Otherwise, they wouldn't have got their A rating. To get the A+ rating, you have to have, and Jonathan, you can correct me if I'm wrong here, you have to have revenues in excess of $1 billion. So S&P, from what we understand, are looking at the technical merits more so these days because of investment volatility. So if the combined ratios are looking more healthy, they're probably not too concerned if some cashback goes back to the membership. And if Steamship are very generously giving 7.5 back, they're also trying to get the rates up by 5% to deal with the premium adequacy. There's a net position thereafter, which is positive for the owner, but I don't think is going to impact the balance sheet too much. And it's there to help the budget, I suspect. I don't know if you think that's fair, Jonathan, or unfair.
Yeah, that's right. I mean, obviously, we had our rating improved, the negative outlook that we had really across the industry following the poor pool outcome in 2020 and 2021 was removed for the club during the course of this year. And that was a decision that was made around the improvement in our combined ratio that was reported at 20th February. So that's the really the situation I was referring to, that they gave a negative outlook, notwithstanding that our capital position was exceptionally strong. They gave a negative outlook because of the claims development and the underwriting implications that followed that. So they are, as I say, looking at two big signals for the clubs, both underwriting performance and capital.
Right, in terms of the rate increases themselves, I mean, we're seeing a sort of two-way split so far, with Gard, Steamship and shipowners looking for 5%, and Britannia, the UK club, and West looking for 7.5%. These are the most modest general increases since 2020. So is the rate of increase slowing down? Can we expect more stable prices in future? What do you say to that, Alex?
Yeah, I think we've been talking about P&I rises for the last 3 years, David. I think in the beginning we could see um, rates going up by 40 to 50% plus RI, and that's come to fruition. Our outlook for the next 3 years is 5 to 7.5 for the next 2 years, and probably 2.5 or 0 to 5% in 2027. Very much depending on claims, essentially. But the influx of that premium increase into the market takes time to see the results change. So we think P&I is becoming predictable again. It has always been fairly predictable, but it's even more predictable in terms of we've passed the peak of the market. We just need to get through the next 3 years, which we think could see compound rises over that period to the tune of 15%. But of course, that all needs to be negotiated. There's going to be other variables involved in that too. The biggest challenge for the clubs is, as I say, dealing with the rating challenges and churn. The world fleet's getting older. The ships that have been in the system for a long period of time are paying the biggest premiums. So in the next 5 years, you'll see that tonnage come out of the market and that premium also disappear. So that will drive some future challenges for the P&I market as well.
Jonathan?
I think that's a good point. Yeah, I'm just saying, David, I think that Alex makes a very good point about the impact of churn and how club underwriters manage that effect. I think it's something that we ask our underwriters to look at fleet to fleet, and the situation will vary depending on the way that individual ship owners replace their tonnage. So I think that is a factor, and we do look at that for individual members. As far as the future rating, absolutely, David. I mean, I think we're all looking to try and stabilize cost and keep costs, keep rating increases as low as possible. That's certainly the instruction we get from our board. However, this is all driven by claims performance. And as Alex says, we're going to be looking very carefully at the way claims develop in order to set rates in the future. And we've seen an awful lot of volatility, particularly in the large claims, particularly those claims that fall on the pool, where we make our contributions to other clubs. That's been the area where we found it most difficult to predict and to model outcomes. And I don't think that's going to change. So whilst I share Alex's hope that we can limit general increases in the future to very low levels, we're going to have to wait and see.
Right. And last question. The extraordinarily benign pool claim situation we had last year, after 2 years when the scheme was running at record-breaking claims levels, must be one of the factors that has contributed towards the current improved climate, the better combined ratios, the lower general increases. However, we were very lucky last year with a one-off year of of an exceptionally benign claims environment. I hear that we're not shaping up so lucky this year. So is that going to turn the pressure back on?
I'm not sure about turning the pressure back on, David. I think that, and you would expect this of us. We are very conservative and prudent in our projections of these claims. So we're not looking at the 2022 policy year and expecting that to be repeated in the future. But neither are we looking at the worst years and projecting our claims on that basis either. We're taking a mean, we're taking an average of performance and projecting on that basis. So no, the current year is not surprising us. It's still very much in its infancy in terms of claims development, and an awful lot can happen in the next 6 to 12 months around these large claims and the development of those claims. So I think we're certainly not seeing a repeat of the very benign outcomes that are materialized in 2022, but neither is it beyond our expectations.
Right. Any thoughts on this one, Alex?
I see the question in two parts. Really, the 2023 year is looking more like a traditional year. 2022 is lucky, but let's not forget that 2019, 2020, and 2021 also saw some serious deterioration to the tune of around $450 million. So the cost of dealing with very large claims is getting even more expensive, and with improving technology and the demands on ESG requirements these days, if you had a wreck removal case where you couldn't get down to the depth to remove a ship or part of the ship or whatever that might be, today the technology is getting sophisticated enough to now remove wreck, let's say, and that's going to cost a hell of a lot more in the future. So that's something to think about. And then the second part of that is obviously the reinsurance market has had a bit of a respite from P&I losses, and the sentiment that we feel and hear from that market is that 2024 should also see a flattening of reinsurance pricing, and maybe even a small adjustment downwards for dirty tankers and passengers. But we don't know that for sure. It's only kind of what we hear in the market. And we'll have to wait and see what happens in the next few weeks, I suspect.
West of England is one of the international group's middleweights, some way behind Gard and NorthStandard, but some way ahead of the smaller clubs. Its chief executive, Tom Bowsher, is well known for his policy of de-risking, which is a polite way of saying that owners with poorer claims records have been told to look elsewhere for their blue card. 2 years ago, that meant bidding farewell to 20% of the club's book. But Bowsher's leaner but fitter strategy seems to have had the desired effect. The following year, West achieved its first positive combined ratio for some time, at 97%. In other words, total expenditure on claims and operating costs was 3 percentage points less than premium income, which meets the famous happiness criteria of Dickens' character Wilkins Micawber. Nevertheless, its members face a 7.5% general increase this year. West is not in the position to make a distribution, but it would do so if it could, explains Tom.
So, West of England is this year opting for a 7.5% general increase, more for owners with poorer claims records and increased deductibles. I mean, that is West's lowest increase for 3 years, but still puts you at the upper end of this year's spectrum. So, what would you say by way of justification?
Well, I think you're right. It is the lowest general increase that we've applied. We're still a club that feels the general increase is a helpful and the fairest tool to use at renewal. There is a split now within the group as to how each club approaches the renewal as far as looking at increases. Some now have internal targets. We are seeing still claims inflation. We are both social and economic. We also see some trends in claims that we are a little bit concerned about in certain sectors, some of which have been acknowledged by our peers in the group as well as the international group generally. And if you look at the average combined ratio across the group last year, it was still over 100% at around 104%, and that was despite a very, very benign pool year. So I think there is still some work to do across the group. We've never been afraid of stating what we need and ensuring the club's capital position continues to strengthen, which it is doing, and we're very transparent about that.
Okay, great, thanks. One of the themes of this year's renewal round is that 3 of the clubs that have announced so far are offering cash refunds to members. In one case, offsetting the rates increase twice over. What are your thoughts on that? Is this something West would consider if it were in a financial position to do so?
Yeah, of course. We're a mutual. If we are in a position to return cash back to our members, we will do that. And we review this on an annual basis. At the moment, whilst the club's capital position has strengthened considerably from a few years ago, and we're well within the tolerances set by our board, which is a member board, as you know, so members entered with the club. We feel at this renewal it's a bit premature to be looking at that. I think though there are three clubs, I imagine my forecast will be they'll probably be the only three clubs that give money back, but I might be wrong. But I think most clubs now have announced. And they are in the fortunate position to be able to do that. It does vary across those three clubs as to the actual amounts that are being handed back, but good for them. But the fact is they are all announcing an increase on the renewing rates, which shows that they still feel like the West, that there are certain areas that need to be addressed. And so the underlying premium of those clubs, like the West and the other clubs, will slowly increase to reflect the pressures that we're all under at the moment, as I alluded to a moment ago.
Right. You spoke to Lloyd's List in June and highlighted the prospect of what you described as unprecedented back year deterioration. Are you still worried about that, or has that eased off, that spectre?
Well, in June, I think your memory's better than mine, but I think it was more to do with the pool. The pool development which we were seeing was unusual and unexpected. We saw significant pool deterioration across particularly 2020 and 21. Looking at the claims development of those years compared to prior years and more recent history, it was very, very unusual. The Danit and the Beijing pollution incident off California produced two pool claims that both exceeded the 100 million and into the excess layers. All clubs have had to absorb that. And so whilst our own members' claims trend are improving, and we are seeing some improvements on the back years, which is what I referred to in our recent circular, the one concern, which I've heard from many of my peers as well, has been the pool deterioration that we've seen.
Right. You mentioned earlier combined ratios, which you said you thought was still too high, 104% on the average. On the other hand, though, that is a lot better than we've seen in recent years when clubs have been going as high as 140, 150. I noticed that yourself, you made a small surplus last year. You came in at 95%. Is that a pointer that we're witnessing some sort of welcome return to stability, or are we not out of the woods yet?
Well, we have, talking about West very briefly, yes, we've made significant improvements to our technical performance. And I think we were in the upper quartile of the group last year, in the 90s, as you say, and we did have an underwriting surplus. We did have as all clubs did, have an investment loss, which is a paper loss, but it's still nevertheless a loss. So that's why we saw reductions across I think all free reserves bar one club. The pool, last year's results, though, are heavily weighted towards the very benign pool. So this time last year, I still don't think we'd had a pool claim notified, which is incredibly unusual. If you had a more normalised pool, I would say you could be on average adding around 10 to 15% on some of the combined ratios. So that's the point. And what we're seeing this year is a more normal pool. It's still relatively quiet as pool claims and pool years go, but we have, I think it's 7 claims as at today. I think there are a few other claims out there that are yet to be declared to the pool. Those clubs are obviously working on those, but we are seeing that normalise a bit more. So if you did normalise the pool for last year, then the combined ratio, the average of 104 across the group, would probably be more like 115, maybe higher 110s, and therefore there still is an underlying rating issue for the day-to-day claims.
Right. Finally, another live topic right now is sanctions, of course, particularly the role that marine insurers are expected to play in ensuring compliance with the Russia oil price cap. How much effort are you having to put into that compliance? Is that taking up a lot of management bandwidth?
Yeah, it is. It's a huge area and top area of focus that we are having to address. All clubs are. There's a lot of work that goes with monitoring ship movements and ensuring we have the necessary documentation in place. We are tier 3 actors, so we're not here to enforce those sanctions as a tier 1 or a tier 2 actor would be. It is a huge amount of work, something we take incredibly seriously at the West. We have seen certain vessels cover terminated as a result of sanctions. But we also work with our members to ensure that they get the necessary guidance, because this is an area that is not particularly easy to follow. There are changes in the sanctions frequently. And if you look at our website and the work that we do, we're here also to advise and guide our members, not just look at those that are potentially in breach of them. And some may be unknowingly in breach, and we work with those members as well. But it's both monitoring it and ensuring that we abide by those sanctions, as well as giving the necessary advice and guidance to our members as well.
Our final guest is Thya Kathiravel, Chief Underwriting Officer of NorthStandard. The North of England P&I Association was founded in 1860 and the Standard Club in 1884. The current entity dates back as far as February 2023, when the two previous rivals joined forces. What are NorthStandard's pricing intentions for 2024, I hear you ask? Well, when we pressed the record button on this clip, we still didn't know. The club held a board meeting on Wednesday and Thursday to make the crunch decision. That queued up Dave nicely with an obvious first question.
Okay, so the obvious starter question, I guess. NorthStandard held its board meeting on Wednesday and Thursday this week. What did you decide for the renewal round?
So thank you, David. Good morning. So we've had a couple of days of meetings earlier this week in Windsor, and the board are coalescing around a general increase mechanism again for the 2024 renewal. We are likely to announce a 5% general increase for P&I and FD&D, and that will probably follow on Monday.
Cashbacks have been perhaps the big theme of the current renewal round, with 3 clubs choosing to redistribute some of their surplus to members. Why didn't NorthStandard decide to go in for one?
So I think there is an interesting mix of reasons for why certain clubs have been giving capital returns or cashbacks, as you call it, David. The clubs are all at different places in terms of the amount of surplus capital that they might have. As NorthStandard, we made it pretty clear at the beginning of the merger process that the efficiencies and savings and the build-up of surplus capital would take a few years. It wouldn't happen immediately. And so there was, as part of our original merger announcements last year, an anticipation that it would take a few years for us to get to the same position in terms of capital as some of the other clubs. And I in saying that, you're probably referring to Gard and Britannia in particular.
Right, okay. I'm assuming you're going into the renewal round as a united entity and not 2 separate entities as you had to last year.
That's correct, David. We are renewing as NorthStandard, the combined entity now for the first time at the 2024 renewal. The members will receive a consistent renewal message, renewal offer, and the documentation will be consistent as well as NorthStandard.
NorthStandard's combined ratio for the last policy year came in at 92%, which I think was second best in the international group. Does that give you any leeway on pricing this year? Is there a bit of slack there maybe?
So the combined ratio was actually 95%, not 92%. It was amongst the best results in the international group, but I think it was largely born out of an exceptionally good pool claims year. I think, and certainly the 2023 year has already revealed that pool claims are slightly more elevated than they were in 2022. But it also, the general increase rather, also reflects the fact that we do need to price in for inflation going forwards and for premium churn, and that's why there will be a general increase, as there has been for most clubs already.
Right. So tell me about the progress of the merger. Is everything going smoothly?
Yes, David. The merger involves a lot of hard work, obviously, but the target operating model for the combined club is in place. The teams, certainly the client-facing teams, are all in place in the new structure, and in terms of processes and procedures, that is all very much in place, ready for this renewal. Not just for the mutual renewal, but for the renewal of all the diversified and specialty sectors as well.
Right, so one final question then. Another big issue for the clubs right now is sanctions. I mean, it's pretty much public knowledge that North, as was, lost Russian-owned tonnage it could no longer legally insure last year. Is the issue still a headache for you?
Yes, we did have to cease our entry for Softcomfort last year, as did a number of other clubs who also had that particular large tanker owner as a member. The sanctions issue is now playing out in the way in which the legal carriage of Russian oil is permitted under the price cap, and the monitoring and enforcement of that price cap by the various countries, the US, the EU, the UK, etc. So it's more to do with the ability and the legality of carrying Russian oil at the moment. That remains the issue going forwards.
And with that announcement from the NorthStandard, 8 clubs have set out their stalls for next February, with news for the remaining 4 due before Christmas. What happens now is that owners will negotiate either directly with their clubs or through the intermediary of a broker for their P&I insurance for the 2024-2025 policy year. It's not the bun fight it once was. Churn is dramatically diminished from even a decade ago, with fewer owners willing to go through the hassle of changing clubs to save a few bucks, not least because that entails having to pay a release call. But some underwriters will no doubt be willing to price keenly to win new business, and some fleets will probably change hands. You will get the very best coverage as the action unfolds from Lloyd's List. In order to read it, of course, you'll have to be a subscriber. Head to lloydslist.com for our best rates. We'll probably be revisiting the outcome in another podcast anyway, nearer the renewal deadline, so keep your ears peeled for that one. But that's it for this week. My thanks to all the guests, and my thanks to Dave for putting together these interviews. And thank you for listening. I'll be back next week with another edition of the Lloyd's List podcast. Have a good week. Bye.